Welcome to another episode of the Washington Retirement Planning Podcast. I'm your host, Ethan Meikle, and I specialize in helping Washington State employees get a better understanding of their confusing retirement benefits so they can utilize that information to hopefully pay less in taxes and retire earlier. In today's video, we're going to talk about one of my favorite topics, which is taxes. Specifically, we were talking about the tax bomb that is hiding inside of your retirement accounts, just waiting to go off. So I really love the analogy of a tax bomb just because it can really feel like that when you get to retirement and you realize just how much taxes you actually owe and how it can just quickly get out of hand and you can end up owing so much more than you even thought possible. The good news is there are actionable ways you can take to reduce the effect of this tax bomb. So I will dive deeper into what this is, how it works, and ways you can reduce the impact it has. After we dive through all of that, the question we'll be answering for today comes again from our content survey. Today, the question we're answering is, how do we make things easier or better for those that will inherit or be a trustee over what I have saved? So that's a great question. It actually ties in quite nicely with the tax topic of today. So we'll answer that question towards the end of today's podcast. Now, before we dive into it, it's important to understand the back end history or where we're coming from when we talk about tax bomb and why do we think it's going to explode. So we know that Congress controls taxes. They decide, what the rates are, the breaks, all of that. It actually has nothing to do with the IRS or what they see fit or what we need to actually balance the economy or our budget. It's clearly what Congress says. So currently, the U.S. has $34 trillion in debt. This is in 2024. And a lot of people hear these big numbers. They don't really quite understand how much money that actually is, what that actually looks like. So here's a couple of visuals to help you realize just how big it is. So if you were to take a US dollar bill, just $1 bill, and put it on the ground, and then put another on top of it, and just keep stacking these over and over again, it would take 3.5 trillion of them to hit the moon, right? That's just one way to the moon. If you want to do a round trip, you need to double that, right? You need about $7 trillion. The US has $34 trillion. That's enough for 4.8 round trips to the moon. So we almost can go to the moon and back 5 times the amount of debt that we currently have. It's also enough if we took that $34 trillion and we're split it amongst the U.S. population, we could write a check to every single individual in the United States for $101,000. If you want to give money away to the entire world of 8 billion people, everyone could get about $4,200. So the amount of money that the U.S. has is absurd. Back in 2020, we only had about $23 trillion before the pandemic, and we've exploded. We've added $10 trillion in just 4 years. So the reason I'm going into all of this is as the national debt explodes, remember that the U.S., anytime we have debt, we have to pay interest. The government is no different. They have to pay interest on their outstanding debt. And in fact, I just came across the article that interest payments from the United States government now has just hit $1 trillion. So $1 trillion a year now is going just to pay the interest off of what they've accumulated. So in order for us to keep spending like how we want to spend, or to even just cover the $1 trillion tax bill, the only way the government brings in money is from tax revenue, or that's the primary source. So if they now have $1 trillion tax, just interest alone that they have to pay, it's hard to make a case for keeping taxes low. I know a lot of the candidates don't want that, but unfortunately, the numbers may not allow them to keep taxes lower much longer. So when we talk about a tax bill that you may be paying in the future, we're talking about your pre-tax retirement accounts. And the way the current tax code is written, it's supposed to expire at the end of 2025. So we have 2 more tax years on the current system, and then it's supposed to revert back to the old way, which is higher taxes and less standard deduction, things like that. Now, Congress can vote to extend it if they want to, keep it the same, which I know a lot of them want to do, but it's hard to make the case for doing that if we have racked up so much debt. It's only a matter of time before taxes have to go up to attempt to bring the national debt down, or at least balance it out some, because it's getting to a point where it's just trying to stack on too much interest, and it's going to be really, really hard to pay back. And the country wants to avoid default, they got to do something drastic. Unfortunately, taxes might be the answer. If you're looking for a really good resource or want more information on this, there's a book, also a movie called The Power of Zero. And it goes all into the U.S. debt and how their case for taxes going up in the future and what you need to do to protect your families. So I watched it. It's a great film. I encourage you guys to look at it if you have the time. What I'm going to talk about today is what was covered in that film. Specifically, it's going to be how it impacts you guys as Washington State employees. All right, let's dive into it. So the thing that your 403b, DCP, and Plan 3 retirement accounts all have in common is that they're all pre-tax retirement accounts. So you've chosen to take a tax deduction today. So you're saving taxes money today. It's going to defer the taxes into the future. And at some point in the future, you're going to have to owe taxes then. And obviously, that's the reason why you've probably chosen to get into one of these plans, because it sounds like a good deal. I get a tax deduction today while I'm working and probably paying more taxes. In the future, I'll be making less money, therefore I'll be in a lower tax bracket, and I'll pay less taxes then. That's what you've been told, but is that really true? Unfortunately, it's probably not. If you look at the current circumstances of our country and the way our tax code is written, in 2025, the tax code is going to be going up. It's just written in our tax code as it is. If you look at all the stimulus money, currently just $6 trillion has been pumped into the economy. There's only one way that we can actually pay for that as a country. And what's the only way that governments get their money is from taxes. So it's kind of naive to think that taxes will not be increasing to pay off our national debt. That's going to be north of $30 trillion by the end of this pandemic. So now why does any of that matter, and how does it affect your specific retirement accounts? Well, when taxes go up, they're going to affect you in the future. So even if you may be making less money and drop a tax bracket, that tax bracket could potentially be at a higher rate anyways. So it's definitely possible to be in a lower tax bracket than you are today, but still be paying more tax. The other problem is that these pre-tax retirement accounts are the only account in the entire US tax code that force you to take your money out. Whether you want to or not, they're going to require you to take it out. If you choose not to or forget to do it, they're going to assess a penalty of 50% on the amount you're supposed to take out. So these required distributions are called RMDs, required minimum distribution. And it's what the IRS makes you take out each year so they can collect your taxes on it. Now, under today's tax code, age 72 is going to be when you're required to start making these distributions. So now the reason why I call it a tax bond is because while you're saving money into it, oftentimes you put less money into it than you do have interest. So you may have put, say, $100,000 of the course of your career into an account, and by the time you retire, it's probably going to be worth, $200,000, $300,000, $400,000 because you have all that interest growing over time. That's the whole reason why we invest to begin with, right? So the problem with these pre-tax term accounts is you owe taxes on the entire thing. Even though you only put $100,000 in it to begin with, and you got the tax deduction on just that $100,000, you owe taxes on the entire thing. So even if you drop a tax bracket, you still have to owe that tax bracket on the entire amount. And as your account grows each year, it's going to keep your account balance even, if not keep growing beyond that. So as you get older and you're required to take this money out, you're going to have to be pulling money out every single year, and the account's not going to get any smaller typically. So it's a never-ending tax flow or tax problem that you're going to have. Okay, so now for a quick example. How does saving tax on $155,000 of income lead to paying taxes on over $1 million? So we look at the screen here, we'll go through a quick example. So this is somebody starting off at age 35, and they're just saving $5,000 a year, not a crazy amount, and they're going to be earning 7% a year. Now this represents what most people are doing during their growth or accumulation phase, right? Just saving money on a pre-tax basis. So as he puts away that $5,000, it's going to be a tax deduction, so it comes off of his income. So we fast forward to the bottom, now he's age 65, he's been doing $5,000 for 31 years, he's averaged 7% the entire time. So in total, he's put away $155,000, 100% on a pre-tax basis. And if you look at his any account balance here in the yellow, you can see that he has $528,000. Amazing, right? So that's why we want to save as early as possible, because we're going to end up with way more money than we initially put into it. That's why we invest. So that $528,000 still hasn't been taxed yet. So once you retire, and now we're in the protection distribution phase, that money is going to continue to grow for us, right? Money doesn't stop growing just because we're retired. So in this case, this guy actually doesn't really need the money because, hey, he's got a pension, he's got Social Security, maybe some other assets on the side. So he decides, I don't want to touch this money, I'm just going to let it ride. So you can see as he lets it ride, he just scales back his risk. You can see his return now is only 5%. He's going to keep letting it go. And you see at age 72, that's when the required minimum distributions start. So this goes and forces you to take your money out, even if you don't want to or need the money. At age 72, off of $714,000, he was required to pull off $27,000. So his income for that year just went up by $27,000. There's a good chance you may be bumping yourself up into another tax bracket for taking that much money out. But as you can see, every year that goes by, he's taking out more and more money. Why? Because the account is still growing at 5%. Seeing though you're taking out that much money, the interest alone on those accounts, when they're that big, still grows steadily. So you can see by the time this guy is 85 years old, he's taken out a total of $518,000 off of his account and was forced to pay taxes on all of that. In addition to that, you can see that he still has $681,000 sitting in his account, all pre-tax still. So he still owes taxes on all that money too. So when you take the $518,000 that he was already forced to put on pay taxes on, and you add the $681,000 he still hasn't paid taxes on yet, that leads to over $1.1 million of money that you have to owe taxes on. So that's why we refer to these things as a tax trap or tax bomb. It may seem good while you're saving for retirement and getting that tax deduction, but who really wins here? You, who got to reduce your income by $155,000 over the course of 31 years, or the IRS, who gets to collect taxes on over $1.1 million? All right, now let's assume that taxes did change and went down like we think they're going to. So if taxes while we're working are at 25%, and in retirement they're only 15%, who would pay more money in taxes? Would you rather pay 25% on $155,000, or would you rather pay 15% on $1.1 million? The answer is pretty obvious, isn't it? So unfortunately, the whole save money now while we're working because we'll pay less money in the future because we'll be in a lower tax bracket typically isn't going to be true. So it's important to look at the big picture and how things are going to work long term, rather than just looking at a 1 to 2 year, what's going to be best for me now for taxes. So that was just one example of a tax bomb. There are a total of 6 that are probably going to affect you in the future. If you want to know the other ones and how they're going to affect you, I hope this helps you guys clearly understand what the tax bomb is and why it's so important to start taking control of your retirement accounts and not just have it a set it, forget it. Pre-tax is the best way, and don't think about where should I actually be putting my dollars today and what's going to be best for me in the long run. So this video is actually posted on YouTube with the visuals. So when you hear me referencing numbers and screenshots, you can always watch this on YouTube and you can get the visual component to it as well. As far as how do I protect yourself from this, it's one of the best ways to get yourself out of this tax bomb is really just start moving into positions that you can control, things that taxes aren't in the picture anymore. So that would be like investment accounts, Roth IRAs, are two of the easiest ones to get into. Remember that once your money's in these accounts, they're after tax accounts. Taxes have already been paid on it. Any money that grows from that point is yours to keep. Yes, there's capital gains taxes on investment accounts. Historically, they've been fairly lower. Can they change rates on those? Of course they can. Roth IRAs, they grow tax-free. Can the government come back and change that rule as well? Of course, anything is possible, but it'd be a real tough task to go out there and tell millions of Americans that the money we told you is tax-free no longer is. So that's something that, while it could happen, is pretty unlikely. So as far as I'm concerned, I actually don't have any money inside of pre-tax accounts anymore. I've converted every single dollar I had in one into either Roth IRA account or I've been investing into after-tax markets. So I actually don't owe the government anything. So as my net worth grows, when I go from $100,000 to $1 million, I don't owe them anything. I already paid the taxes off initially. So all of my growth going forward is tax-free. So if they decide to raise tax 50%, it's not going to really affect me. And this is what I really tried to hone on with clients and what I'm trying to help them build is to get out of this trap before it's too late. Because the writing's on the wall, the taxes are going to go up. It's really hard to make a case that they'll ever go down or be this low again. So this is why we're so active in tax planning with our clients. If you need help with tax planning and get things situated, we're more than happy to sit down with you, go through some strategies that would apply to you. In fact, I actually keep a checklist on my desk of 19 different tax strategies that everyday ordinary people can utilize to help reduce their tax bills. So not everyone can apply to you every single year, and some of them will only apply when you're in retirement. But this list is something that you can always go back to and use, and is what I use at every single tax return that I review to help keep our tax bill as low as possible overall. So this is something I keep on my desk just to try to help every client I speak with to try to help their overall or their lifetime tax bill be as low as possible. Doesn't mean they're going to pay the lowest amount this year guaranteed. It just means we'll do strategies and steps to help reduce their overall tax bill. Most of them are going to pay more taxes now when they work with us. It's just knowing that 10, 20 years down the road, it's going to be a lot less than it would have been had they not taken the action steps that we put them through. Moving on to question of the day now. The question was, how can I make things easier or better for those that will inherit my savings or be a trustee over what I have saved? So we're looking at passing wealth down to the next generation or whoever your beneficiaries may be. The main thing you're trying to avoid or reduce is probate. So any assets not held in a will typically will go through a probate process. So when we have retirement accounts or anything that we own that has a beneficiary named on it, those will automatically bypass probate. We already know who the beneficiary is. Those accounts also bypass any wills. So if on your Plan 3 account, it says the beneficiary is my wife or my ex-wife, and my will says it's my kids, it's going to go off of what it says on your retirement account. Doesn't matter what the will says, doesn't matter how good of a lawyer has set it up, that's the way the rules work. They go off the beneficiary, not what the will says. You always make sure that those two are lined up to your wishes. So if you're trying to make things easier for them, try to get your beneficiaries updated and keep them updated as best you can. You want to let them know what your wishes are in case something happens to you where you're not able to make changes or you're in some type of reduced mental capacity where you can't do that type of action anymore. At least somebody else knows what your wishes were and they can honor it. Again, that's where the living will is going to come into place, where you can physically write down what your wishes are. Anything that's not held inside a retirement account that doesn't have beneficiaries listed on them will typically have to go through probate. So having your home and stuff in trust will make the process go a lot smoother. There are different types of trusts. A lot of people try to get too fancy with them. They try to avoid estate taxes and things like that. And it's just too complicated when you get into that realm. From the general point, having things in trusts or in wills will typically make things transfer a little bit quicker. Another thing you do to make things better for those that will inherit is it depends on what kind of assets they get. So if they inherit stock, they get a supplement basis. That's one of the best things to pass down is like individual stock accounts. If when they inherit a Roth IRA account, that money comes to them, it's tax-free to spend however they choose to do so. The thing to watch for though is any type of qualified retirement accounts, IRAs, Plan 3, deferred comp 403Bs that are in your name still, where taxes have not been paid on it. When your child or whoever inherits that money from you, anyone that's not a spouse, under the current rules, they only have 10 years to fully distribute that money, which means if they inherit $1 million account from you, theoretically, they have to pull $100,000 out every single year for 10 years to wind that account down. So remember that when money that comes out of pre-tax counts as income. So they're going to be forced essentially to get $100,000 of their income on top of their salary that they're already earning, because most people, when they inherit money, they're still working. They're usually in their peak earning years in their 50s and 60s. That's going to more likely throw them up into either the higher of the tax bracket, if not jump a few brackets, and it's going to have them owe a lot more taxes. So if you're trying to make things better for the next generation, when you pass money down that's after tax, already in stock accounts or a Roth account, it just makes it so much easier. They don't have to worry about getting hit with these massive tax bills. So passing down Roth accounts are going to be so much more efficient. So I work with a few clients where they didn't really see the point on paying so much taxes now to convert their money because they'll never need it. They have enough from Social Security and their pensions. They'll never need to spend down their retirement accounts. And they said, I'll let it grow. I'm okay with paying whatever taxes come out with the RMDs. But as soon as you start bringing the child part of it and how much it's going to hurt them, usually that starts to get them moving a little bit sooner, and they start doing even bigger conversions because they know when they leave this earth, they want to make sure that their children will have the best life possible, and they can hand them the funds that are after tax. It's going to make the transition process so much easier for them, less headache with taxes, and then more likely they're going to be able to keep more of the money that you gave them. Another thing you can do to make things easier is make sure you have an estate plan in place. Wills and trusts are a good first part of it all, but you need to have some type of strategy. If you are going to end up paying any type of estate tax bill, which again in Washington is anytime you have assets over $2 million, that's usually when you have the estate tax bill that comes into play. You want to have some type of plan to pay for that bill. If they don't, then the kids are going to have to pay out of whatever they inherited from you. And you might be okay with that, but there's more efficient ways to pass wealth on than just letting them deal with it. Now, you may think $2 million may seem like a lot, but the key point in Washington is it's not portable. So each couple or spouse may have $2 million exemption, and together it's $4 million. When one spouse passes away, now it's down to just $2 million. Their assets will go to their spouse, and there's no estate tax triggered yet. But when that spouse passes away, that's what triggers the estate tax bill. $2 million isn't what it used to be. There's some people whose homes are now worth $1 million alone, throw in their retirement accounts, cars, rental properties, and $2, $3, $4 million is not out of the question, especially when you consider that this is at the end of your life, not just now. If you're in your 50s and 60s and already have $2 million saved up, you're going to quickly go over $2.3 million in the next 20, 30 years. So estate planning is a real big part, and it will greatly help those that will inherit your money next. All right, so that was a great question. If you want more content like this, head over to WashingtonTouristPers.com. I have all my free content and downloads available on there. If you need help diving into your financial plan, you want to help with the tax planning piece, you want to avoid this tax bomb, then I encourage you to sign up so we can start going through this together. The link to get on my calendar will be in the description below. I look forward to chatting with you guys soon. And with that being said, I'll catch you guys next time. Remember that your future depends what you do today. All right, before I sign off, just a real quick legal disclosure that we're required to say as licensed fiduciary advisors. So remember that this is a podcast. It is designed for educational and entertainment purposes only. I don't know you personally, therefore I cannot give you any personal advice. So please don't take anything that we say on the show as being personal, financial, legal, or tax advice. If you want that kind of stuff, make sure you seek out a professional so they can help you with the strategies and investments that are right for you. Also, please remember that despite the name of our show, we are in no way associated with Washington State or the Department of Finance Systems or any other Washington employer. We are a private-owned firm that specializes in working with Washington State employees, which is why we know so much about this stuff. So remember, we don't work for the state in any way, shape, or form. So please don't confuse us as being an official representative of the state. All right, that's it for the legal stuff. I'll catch you guys all next time.